Just let's talk about corporate bonds for a minute. We're seeing Pfizer with that big deal yesterday. We're seeing it tracking already this month higher than it did last month. We're also looking at ETFs that track corporate bonds, pretty much flat this year, up 0.5% to 1.5% when it comes to the big ones. What's your view on corporate bonds right now? Do you see an upside for the second half of the year?
Yeah, and bonds, we're really always going to have our investors at least in a portion of bonds, because as optimistic as we are with the markets, you do want to make sure you have that piece of safety built in. So that way, if there is something unexpected or we do have a recession later in the year, you can use that as safety in your portfolio, but also as a rebalancing tool to buy back into the markets. We've actually been looking more at like treasuries, even certificates of deposit are paying better than treasuries in some cases right now, as opposed to corporate bonds, at least for individual investors, because there is that additional risk where corporate bonds are going to be more volatile, especially if we do go into a slowdown or a recession, which again, I'm not forecasting, but if it's protection your portfolio, that's what you want to make sure you have in place there.
Well, I mean, I think you're leading me right into my next question, portfolio protection. I mean, we do have this risk, not only the banking crisis, but possible recession, inflation still elevated. What are you advising your clients to do to protect their portfolios in what's really a volatile time right now?
Yeah, and that's where, again, treasuries and certificates of deposit are really what we're looking for in order to reach for safety or protection in your portfolio currently. And again, this being said, you do want to make sure you're invested right now. I'm not saying get fully into bonds, just have a piece of that in your portfolio. So we're very optimistic right now. And if the economy continues on good footing, you're going to want to be invested for that upswing. That being said, though, when you look at bonds, we're having a lot of clients who are looking shorter term because the shorter term bonds are actually paying better interest. This is where I would actually caution investors, unless it's money you're going to be needing in the next couple of months, I would look a little longer on the curve, like even, for example, a year rather than 3 months out, because we're very likely at a peak in interest rates. And so if interest rates do start to come down, you're going to have that reinvestment risk. So I would look to start to even build out a ladder to kind of hedge your risk there, but I would not go too short term here.
Okay. Let's talk about equities for a minute. What do you think about Megacap tech? We're seeing a big run up when it comes to Megacap tech. I'm looking at the triple Qs up about 23% year to date.
Yeah, and a lot of that is concentrated into basically the top 7 stocks right now. It's your Apples, your Googles, your Microsofts, your Amazons. That's about over 80% of the S&P 500 return year to date. So there's this high concentration, really just a couple of companies. And what's happening right now is the valuations are elevated. Yet earnings per share growth over the next several years is actually expected to be a lot slower than it was over the last decade. So this is something, again, I've been cautioning investors, do not be overweight in tech right now, because I think you're overpaying for something that's likely going to be growing slower. And we're likely to be in a higher rate, tighter money environment over the next several years here. And especially a lot of investors might be invested in ETFs or mutual funds. They say, oh, I'm not invested in those 7 stocks. If you're invested in the S&P 500, which is market cap weighted, you are going to be overexposed to this. I would say 80 to 90% of people who come to me don't even realize it when they're in ETFs and mutual funds are way overexposed to just those top 7 stocks. So just keep that in mind when you're in your portfolio.
Well, what's the alternative? Give us a different sector that investors should really take a closer look at.
Yeah, we're definitely favoring value over growth right now. So even think of like your healthcare sector. That's been having an earnings per share growth about 12% since the mid 1980s, with an aging population is likely going to continue to benefit. So those are things like your value companies, which we're favoring over growth. Even international is really undervalued compared to the US right now, which I also think is another great opportunity. So definitely some sectors in the markets that are still really good valued right now.